The March warning. Why the US dollar will officially restart. In 30 days, prepare now, March 11th, 2026. Mark that date. 30 days from now. Because 6 days later, the Federal Reserve makes a decision that hasn't been made in 53 years. Not since Nixon closed the gold window in 1971. Jerome Powell, 79 days left as Fed chair, one final FOMC meeting, one choice. Cut rates and reignite inflation, or hold firm and trigger recession. Either path leads to the same destination, a dollar that no longer functions the way it did. And if the business community isn't positioned before March 11th, before that meeting room door closes, the wealth transfer will be welcome to Morella Macro. If you've built something in your life, a business, a portfolio, a legacy, then what happens in the next 30 days matters more than the last 30 years. We don't do hype here. We do analysis. We do preparation. So if you appreciate straight talk about money, power, and the systems that govern both, click that subscribe button. Think of it like locking your front door at night. Simple, sensible, protects what's yours. And tell us, where in the world are you watching this from? Because what's coming doesn't respect borders. Now, let's break down exactly what the March restart means. 30 days. That is all the time the business community has left. 30 days before the window closes, before the Federal Reserve walks into a meeting that will determine whether the dollar restarts gradually or collapses under its own weight. March 11th, 2026. That is the deadline. 6 days later, on March 17th and 18th, the Federal Open Market Committee gathers. 8 voting members, 1 decision. And that single decision will reshape the dollar in ways most people cannot yet imagine. But here is what makes this different from every other Fed meeting. This is not routine monetary policy. This is Jerome Powell's second to last meeting as Federal Reserve Chairman. His term expires on May 15th, 2026, 79 days from now. Kevin Warsh has already been nominated to replace him, President Trump's hand-picked Fed chair, a man with very different views about how the dollar should be managed. And once Warsh is confirmed, once he takes control, the entire framework changes. The priorities change, the policies change, and the dollar, as the world knows it, changes permanently. But the March meeting is different because Powell is still in charge, still defending Fed independence, still holding the line against political pressure, still trying to preserve what remains of the institution's credibility. And in 30 days, at that March meeting, he will face the most critical decision of his 8-year tenure. Cut interest rates aggressively, like the Trump administration demands, or hold firm and preserve what is left of the dollar's credibility. Either choice triggers the restart. Cut too much, and inflation reignites. The dollar craters. Foreign governments holding trillions in U.S. treasuries start dumping them faster. Confidence evaporates. Hold too long. And the recession deepens. Markets crash. Unemployment rises. Political pressure becomes unbearable. The Fed loses independence anyway. 2 paths. Both lead to the same destination. A fundamental restructuring of the dollar's role in the global economy. Not over years. Not over months. Over weeks. Starting in 30 days. And if the business community is not positioned before March 11th, before that FOMC decision is made, they will be caught on the wrong side of the biggest monetary shift since Richard Nixon closed the gold window in 1971. This is not speculation. This is pattern recognition. Every major currency restart in modern history follows the same 4-stage pattern. And right now, in February 2026, the United States is deep into Stage 3. The March 17th meeting is the trigger point, the moment when Stage 3 becomes Stage 4, when the slow decline becomes the fast collapse, when $38.56 trillion in national debt, $1 trillion in annual interest payments, and 70 years of reserve currency privilege collide with economic reality. And reality does not negotiate. It resets, violently. Let us be clear about what a restart actually means. This is not the dollar disappearing. This is not hyperinflation like Venezuela or Zimbabwe. This is not preppers hiding gold bars in their basements. A dollar restart is an institutional acknowledgement. It is when the Federal Reserve, the U.S. Treasury, and the global financial system officially admit that the old rules no longer work, that the old assumptions no longer hold. It is when interest rates, inflation expectations, currency valuations, and capital flows all recalibrate simultaneously, when the dollar's role as the undisputed global reserve currency gets restructured into something smaller, something weaker, something less dominant, and that recalibration does not happen smoothly. It happens in lurches, in shocks, in moments when trillions of dollars of wealth transfer from those who were unprepared to those who saw it coming. The March meeting is that moment. Powell walks into that room knowing his legacy is on the line, knowing that history will judge him, not by his entire tenure, but by this single decision, knowing that whatever he chooses, the consequences will be irreversible. Does he cut rates and give the economy short-term relief while sacrificing long-term dollar credibility? Does he hold rates high and preserve institutional independence while watching the real economy collapse around him? Or does he try some half-measure compromise that satisfies no one and accelerates the confidence crisis instead of solving it? 30 days from now, the world will know. But the business community that waits until March 17th to react will already be too late. Because the smart money does not wait for official announcements. The smart money positions before the decision is made. And positioning requires understanding exactly how the foundation cracked in the first place. There's a number that should terrify every serious business person in America. Not because it is large. Large numbers appear in economics all the time. Trillions get thrown around in budget discussions like loose change. No, this number is terrifying because of what it represents. $38.56 trillion. That is the total United States national debt as of February 4th, 2026. But here is what makes that number different from every other big number in government finance. It is growing faster than the economy itself, faster than tax revenue, faster than GDP, faster than any realistic growth rate the United States could possibly achieve. And it is not slowing down. It is accelerating. Every single day, the debt increases by $6.43 billion. Every hour, $267 million. Every minute, $4.46 million. Every second, $74,000. Read that again. Every second that passes, the United States government goes $74,000 deeper into debt. While someone reads this sentence, another $500,000 was just added. By the time this section ends, tens of millions more. And it never stops. Not at night, not on weekends, not on holidays. It is a clock that only moves in one direction. Now, some economists will say this is fine. They will point to historical debt levels. They will talk about debt to GDP ratios during World War II. They will argue that as long as the economy keeps growing, the debt is manageable. But they are missing something critical. They are missing the interest. Because it is not just about how much debt exists. It is about how much it costs to service that debt. And in 2026, that cost has crossed a threshold that changes everything. Interest payments on the national debt are now exceeding $1 trillion per year. $1 trillion. Just in interest. Not paying down the debt, not reducing it, just the cost of keeping it alive. To put that in perspective, the United States government now spends more on interest payments than it spends on national defense. More than it spends on Medicare. More than nearly every other category in the federal budget. And here's the trap. To pay that interest, the Treasury has to borrow more money, which creates more debt, which generates more interest, which requires more borrowing. It is a compounding spiral. And once it starts, there are only two ways to stop it. Either grow the economy fast enough to outrun the interest, or restructure the debt itself. And the economy is not growing fast enough. Look at the Treasury's own numbers. Released February 3rd, 2026, the quarterly refunding statement. The U.S. Treasury expects to borrow $574 billion between January and March 2026 alone. $574 billion in 3 months. That is $191 billion per month. And next quarter, April to June, another $109 billion. Total, $683 billion in 6 months. Annualized, $1.4 trillion every single year, forever, because nothing in the federal budget is being cut. Defense spending is up, Social Security is up, Medicare is up, and now interest payments are exploding. This is not a temporary deficit caused by a recession or a war or a one-time emergency. This is structural. This is permanent. This is the new normal. And the rest of the world is watching. Because the United States does not fund this debt alone. Foreign governments hold over $7 trillion in U.S. Treasury securities. China, Japan, the United Kingdom, oil-producing nations in the Middle East. For decades, they bought treasuries because they were safe, because the dollar was stable, because the United States always paid its debts. But something changed in the last 18 months. They stopped buying as much. Treasury International Capital data shows foreign purchases of U.S. debt slowing significantly, not collapsing, not panicking, just slowing, quietly, steadily. And when they do buy, they are choosing shorter maturities, 3-month bills instead of 10-year bonds. Why? Because shorter maturities mean less risk, less exposure, an easier exit if things go wrong. This is not a vote of confidence, this is a vote of caution, and caution in global finance is the early warning signal that comes before the storm. Now add one more factor into this equation, the debt to GDP ratio. As of early 2026, U.S. government debt is above 120% of GDP. That means the total debt is bigger than the entire economy. Historically, when developed nations cross this threshold, two things happen. Either they experience a period of rapid growth that brings the ratio back down, like the United States did after World War II, or they experience a currency crisis that forces restructuring. There is no third option. And in 2026, the United States is not experiencing rapid growth. It is experiencing slowing growth, rising unemployment, weakening consumer spending, corporate profit margins shrinking. The post-war playbook cannot be replicated. The conditions do not exist, which leaves only one path: restructuring. And restructuring does not happen through smooth policy adjustments and polite negotiations. It happens through shocks, through moments when the system can no longer pretend the math works. The fiscal foundation did not crack in February 2026. It cracked years ago. March 17th is simply when the Federal Reserve has to stop pretending it did not. Imagine being handed a puzzle with 3 pieces. Each piece represents something vital: price stability, full employment, financial system stability. Now imagine being told you can only keep one. The other 2 will break. Not might break, will break. And whatever choice you make will be recorded in history, studied in textbooks, blamed for whatever comes next. That is the position Jerome Powell walks into on March 17th, 2026. This is not a normal Federal Reserve meeting. This is not about tweaking interest rates by a quarter point and seeing how markets react. This is about choosing which part of the economy survives and which parts get sacrificed. Because in a dollar restart scenario, the Fed cannot save everything. It never could, and Powell knows it. So let us walk through his options, all 3 of them, and why every single path leads to the same destination. Option 1, cut rates aggressively. This is what the Trump administration wants. Cut rates hard, 75 basis points, maybe a full 100, flood the system with cheaper money, give businesses relief, give consumers relief, restart growth. On the surface, it sounds reasonable. Lower rates mean cheaper borrowing costs. Companies can refinance debt. Homebuyers can afford mortgages again. The stock market rallies. Unemployment stabilizes. The recession that everyone fears gets postponed for about 6 months. Then the second order effects kick in. Inflation, which was finally starting to cool, reignites. Because cheaper money means more spending. More spending means higher demand. Higher demand with constrained supply means rising prices. And once inflation expectations shift, once people start believing prices will keep going up, the psychology changes. Workers demand higher wages. Businesses raise prices preemptively. Contracts get renegotiated with inflation clauses baked in. The 1970s playbook repeats itself. But here's the worst part. Foreign holders of U.S. Treasuries watch this happen in real time. They see the Fed choosing short-term political relief over long-term currency stability, and they make a calculation. If the Fed is willing to sacrifice price stability to avoid a recession, then holding trillions of dollars in Treasury bonds is no longer a safe bet. It is a depreciating asset. So they start selling. Not all at once, not in a panic, just steadily, quietly, moving capital into euros, into yen, into gold, into anything that is not losing value as the dollar weakens. And as foreign demand for treasuries drops, yields rise, which makes the debt even more expensive to service, which forces the Treasury to borrow even more, which accelerates the spiral. Aggressive rate cuts do not solve the problem. They accelerate the collapse. Option 2, hold rates high. This is the Fed independence argument, the institutional credibility defense. Powell could walk into that March meeting and say, no, inflation is not fully defeated yet. We hold the line. Rates stay restrictive. We do not cave to political pressure. In theory, this preserves the Fed's reputation. It sends a message to the world that the United States will not sacrifice currency stability for short-term growth. In practice, it triggers a different kind of disaster. Because the economy in early 2026 is already fragile. Corporate America is sitting on a debt maturity wall. Trillions of dollars in corporate bonds issued during the low-rate era of 2020 and 2021 are coming due in 2026 and 2027. Companies that borrowed at 2% interest now have to refinance at 6 or 7%. Many cannot afford it. Commercial real estate is even worse. Office buildings half empty due to remote work, shopping malls dying, hotels struggling, and all of it financed with cheap debt that is now resetting at much higher rates. Defaults start piling up, not just small businesses, major corporations, recognized names, the kind of companies people assumed were too big to fail. Unemployment rises, consumer spending collapses, the recession everyone was trying to avoid arrives anyway. And then the political pressure becomes unbearable. Congress holds hearings. The administration attacks Powell publicly. Calls for his resignation intensify. The narrative becomes the Fed caused this recession by being too stubborn, by caring more about textbook economics than about real people losing real jobs. And once the Fed loses political support, its independence is gone anyway. Holding rates high does not preserve credibility. It destroys it through a different mechanism. Option 3, the compromise. So maybe Powell tries the middle ground. Cut rates, but not aggressively. 25 basis points, maybe 50. Enough to signal the Fed is listening. Enough to ease some pressure, but not enough to reignite inflation fears. The problem? This satisfies no one. Markets wanted aggressive cuts. They do not get them, so stocks sell off anyway. Inflation hawks wanted rates held high. They do not get that either, so bond yields rise as credibility erodes. Businesses still cannot refinance affordably. Consumers still struggle, the recession still happens. But now there is an added problem: confusion. Because a compromise does not send a clear message. It does not communicate a coherent strategy. It looks like the Fed does not know what to do, like it is guessing, like it is reacting instead of leading. And in global finance, confusion is worse than a clear bad decision, because at least a clear decision can be priced in. Markets can adjust, capital can reposition. But confusion creates paralysis, and paralysis creates volatility, and volatility creates panic. The compromise path does not prevent the restart. It accelerates the chaos. So there it is. 3 options, 3 outcomes, all bad. This is not about Powell making a mistake. This is about Powell being handed an impossible situation that was decades in the making. The fiscal foundation cracked years ago. The debt became unsustainable years ago. The structural deficits became permanent years ago. Powell did not create this trap. But on March 17th, he has to choose which way the trap closes. And 79 days after that decision, Kevin Warsh takes over. A different Fed chair, a different philosophy, a different set of priorities. Which means the March meeting is not just Powell's final major decision. It is the last decision made under the old framework. After March 17th, everything changes. The question is not whether the dollar restarts. The question is whether the business community positions before the restart is announced, or scrambles after it is already underway. Understanding the dollar restart is valuable. Positioning before it happens is survival. Because here's the truth that separates those who preserve wealth during currency transitions from those who lose everything. Knowledge without action is just expensive entertainment. The business community now has the analysis, the timeline, the framework. 30 days until March 11th, 6 more days until the FOMC meeting, 79 days until Powell's term ends and the entire monetary regime changes. But analysis does not protect capital. Positioning does. And positioning requires making decisions that feel uncomfortable right now, but will feel obvious in hindsight. So let us talk about what actually needs to happen in the next 30 days. Step 1. Assess dollar-denominated exposure. Every business, every investor, every entrepreneur needs to ask one question. How much of my wealth is tied directly to the dollar's current value? Not just cash in a checking account, everything. Treasury bonds, corporate bonds, money market funds, dollar-denominated savings, business revenue that only comes from U.S. customers, contracts priced in dollars with no inflation adjustment clauses, all of it. Because when a currency restarts, the people who get hurt worst are not the ones holding a little cash for daily expenses. It is the ones who went all in on dollar-denominated assets because they assumed stability would last forever. It never does. So the first move is simple. Inventory everything. Write it down. Percentage of total wealth in dollars, percentage in other currencies, percentage in hard assets, percentage in equities with international exposure. Most people have never done this exercise. They have no idea how concentrated their exposure actually is. And concentration is risk. Step 2, reallocate into hard assets. Every major currency restart in history follows the same pattern. Paper assets tied to the weakening currency lose value. Hard assets that cannot be printed or devalued hold value or appreciate. Gold is the most obvious example. As of early February 2026, gold is trading above $2,850 per ounce. Some analysts call this overvalued. Some call it a bubble. They are missing the point. Gold is not rising because of speculation. It is rising because smart institutional money is already positioning for the restart. Central banks in China, Russia, Turkey, India, they have been accumulating gold aggressively for years. They know what is coming. And here is the key distinction: physical gold versus paper gold. ETFs and futures contracts are convenient, but they are still financial instruments, still tied to the system, still subject to counterparty risk. Physical gold is different. It exists outside the banking system, outside government control, outside the mechanisms that can be frozen or restricted during financial crises. Does every business person need to buy gold bars and hide them in a safe? No. But should a meaningful percentage of wealth be in assets that are not purely dollar-denominated paper? Absolutely. Silver, platinum, real estate in stable jurisdictions, commodities, anything with intrinsic value that does not depend on the dollar maintaining its current strength. Step 3. Diversify equity holdings strategically. Not all stocks are created equal during a dollar restart. Some companies thrive, some get destroyed. The difference comes down to 3 factors. First, revenue diversification. Companies that generate most of their revenue outside the United States benefit when the dollar weakens. Their foreign earnings convert back into more dollars. Exports become more competitive, international operations become more profitable. Companies that only sell domestically and import their materials suffer. Second, pricing power. Can the company pass rising costs onto customers? Or do they get squeezed between inflating input costs and price-sensitive consumers? Businesses with strong brands, essential products, or monopolistic market positions can raise prices. Commodity businesses with thin margins cannot. Third, balance sheet strength. Does the company have manageable debt, or is it over-leveraged with refinancing deadlines approaching? In a high-rate environment caused by Fed policy or currency instability, companies with clean balance sheets survive. Over-leveraged companies default. So the strategic move is not to abandon equities. It is to shift into companies positioned to benefit from dollar weakness rather than be destroyed by it. Step 4. Consider currency diversification. The dollar will not disappear, but its dominance will shrink, which means holding some wealth in other currencies becomes not just smart, but essential. Swiss franc, historically stable, backed by a country with fiscal discipline and strong institutions. Singapore dollar, a surplus nation with minimal debt and a government that manages currency carefully. Norwegian krone, resource-backed, stable political system. Sovereign wealth fund providing long-term strength. These are not speculative bets. These are stability hedges. The goal is not to predict which currency becomes the next global reserve. The goal is to avoid being 100% concentrated in the one currency undergoing structural reset. Step 5. Adjust business operations. For entrepreneurs and business owners, the restart is not just an investment problem, it is an operational problem. Supply chains need to be stress tested. If the dollar weakens significantly, what happens to import costs? Can suppliers handle currency volatility? Are there alternative sources in different currency zones? Pricing strategies need flexibility. Fixed price, long-term contracts become dangerous. Inflation adjustment clauses become essential. Debt needs to be managed. If a business is carrying variable rate debt, now is the time to refinance into fixed rates before volatility spikes. Working capital needs buffers. Currency transitions create temporary chaos. Payments slow down. Credit tightens. Businesses with cash reserves survive. Businesses operating on thin margins collapse. Step 6. Understand the March 11th deadline. Why does all of this need to happen before March 11th? Because once the FOMC meeting starts on March 17th, the repositioning window closes. Institutional investors do not wait for official announcements. They front-run policy changes. They position before decisions are made public. They move billions of dollars based on probabilities, not certainties. And when they move, liquidity disappears. Asset prices gap. Spreads widen. Execution quality deteriorates. The difference between repositioning strategically on March 10th and panic selling on March 18th is the difference between preserving wealth and destroying it. History proves this again and again. The investors who survived the 1971 gold window closure were the ones positioned before Nixon's announcement. The investors who survived the 1985 Plaza Accord were positioned before the dollar devaluation was official. The investors who survived 2008 were positioned before Lehman collapsed. They did not have perfect information. They had pattern recognition. They understood structural fragility. And they acted before the crowd panicked. The final question. So here is what every business person must ask themselves. What is the cost of being wrong? If this analysis is incorrect, if the dollar restart does not happen, if March 17th comes and goes without major consequences, what is lost? Modest opportunity cost. Maybe some assets underperform for a while. Maybe portfolio returns are slightly lower than they could have been. That is it. But what is the cost of being unprepared? If the restart does happen, if the dollar's role restructures, if currency volatility spikes and foreign holders dump treasuries and inflation reignites or recession deepens, then the cost is not modest. It is catastrophic. Entire businesses fail. Retirement accounts evaporate. Generational wealth transfers from the unprepared to the positioned. That is the asymmetric risk. Small downside if wrong. Enormous downside if unprepared. Which means the rational choice is obvious. Position now, before March 11th, before the window closes. Because the March FOMC meeting will not announce a dollar restart in bold headlines, but the decisions made in that meeting will set the restart in motion. And by the time it becomes obvious to everyone, it will already be too late to act. 30 days. The clock is running.